All right, let's dive into performance audit. Now, for your CA final exams, it's crucial to understand that a performance audit isn't just a routine check. It is an objective and systematic examination of evidence. The core goal here is to provide an independent assessment of how a government organization, a specific program, or a function is performing. Why do we do this? To improve public accountability and to give decision makers the information they need to take corrective action.
In the context of public sector undertakings, or PSUs, these audits are conducted by the C&AG, which is our supreme audit institution through the various subordinate offices of the Indian Audit and Accounts Department. These offices don't just wing it. They are strictly guided by the manuals and auditing standards prescribed by the C&AG. Essentially, this audit helps those in charge of governance to see if the decisions made by the legislature or the executive are being implemented efficiently and effectively. Most importantly, it asks the big question: have the taxpayers and citizens actually received value for money?
To determine this value for money, the C&AG guidelines focus on three key pillars. The first one we need to master is economy. When we talk about economy, we are looking at minimizing the cost of resources used for an activity. But be careful, it's not just about the cheapest price. It's about getting the right quantity and the right quality at the best possible price. When you are judging economy, you are forming an opinion on the human, financial, and material resources deployed. You're assessing whether these resources were acquired in a timely manner and used economically.
To give you a practical feel for this, an auditor looking at economy would ask questions like, were the best prices obtained for consultancy services? Is there a way to reduce the cost of sickness absences? Or, for example, are there procedures to ensure that transport costs for food aid are kept at the lowest available rate? Ultimately, the auditor is looking to see if there has been any waste of resources in achieving the desired output.
Now, let's dive into the overview of auditing public sector undertakings, specifically focusing on the core pillars of a performance audit: economy and efficiency.
First, let's talk about economy. When we audit for economy, we are essentially looking at the cost of resources. The goal here is to ensure that the organization is acquiring the necessary resources at the lowest cost without compromising quality. To make this practical, think of it as asking a series of value for money questions. For example, as an auditor, you would ask, did the entity get the best possible prices for consultancy services? Is there a way to reduce the costs associated with sickness absences? Or, in a humanitarian context, are there strict procedures to ensure that the transport costs for food aid are kept to the absolute minimum? Ultimately, you are checking if there has been any waste of resources in achieving a specific output.
Moving on to efficiency. While economy is about the cost of inputs, efficiency is all about the input-output ratio. In the public sector, efficiency is achieved when we maximize the output using the minimum amount of inputs, or conversely, minimize the inputs for a specific level of quality and quantity of output. When you are auditing efficiency, your focus shifts toward the processes how the organization transforms those inputs into outputs. You'll want to examine several key areas. Are procurement practices sound? Are resources properly protected and maintained?
Are human and financial resources being used to their full potential? You should also check if the staff, equipment, and facilities are optimized to deliver goods and services in a timely manner and whether the overall management and operating procedures are executed cost-effectively.
To put this into practice, you can ask targeted questions. For instance, if you're auditing a training program for the unemployed, you might ask, how does the cost per job created here compare to similar programs elsewhere? Or, regarding a specific project, you could ask if it could have been implemented differently to improve timeliness and quality. You might also investigate whether schools are maximizing the use of their IT equipment or if there are clear criteria for prioritizing transport infrastructure projects to ensure the maximum possible impact.
Now, let's dive into the core pillars of performance auditing. We've already touched upon efficiency, but now we need to focus on a critical concept: effectiveness. When we talk about effectiveness in a performance audit, we are essentially asking, did the program actually do what it was supposed to do? It is the measure of the extent to which objectives are achieved and the relationship between the intended impact and the actual impact of an activity. To make this practical for your exams, think of auditing effectiveness as a comprehensive evaluation. For instance, a performance auditor might assess whether the legal and financial means provided for a public sector program are actually suitable or relevant to the overall policy.
They will determine if the program achieved the desired results and, very importantly, use evidence to establish if the social or economic impacts observed were actually caused by the policy or if they happened due to some other external factors.
Furthermore, the auditor will look for bottlenecks, those factors inhibiting satisfactory performance. They will check for redundancies, seeing if the program duplicates or overlaps with other related initiatives. They'll also evaluate if management considered better alternatives that could have yielded the same results more effectively or at a lower cost. Beyond the results, the auditor examines the machinery behind the program. This means assessing the adequacy of the management control system used for monitoring and reporting, ensuring compliance with applicable laws, and ultimately identifying ways to make the program work more effectively.
To put this into a real-world perspective, effectiveness focuses on specific, outcome-based questions. For example, if a government builds a new highway, the auditor asks, has this infrastructure actually increased traffic flow while improving safety and reducing journey times? Or, in an environmental context, they might ask, have suitable measures to mitigate environmental impact in a specific sector been properly implemented? Essentially, the goal is to see if the entities are achieving their objectives for all sectors of the community.
Now, let's dive into the performance audit cycle. This is a crucial part of the audit of public sector undertakings, and it's best understood as a continuous, structured flow. Think of it as a roadmap that the Supreme Audit Institution, or SI, follows to ensure that government spending is actually achieving its intended goals.
It all starts at the top with strategic planning. Here, the SAI defines its overarching strategic goals and objectives. This high-level vision is then translated into a formal strategic plan document and an annual operational plan.
Once the broad strategy is set, we move into the planning phase for individual performance audits. This involves creating a specific individual performance audit plan for the subject at hand. To make this plan effective, auditors conduct a preliminary study and develop discussion papers, audit observations, and detailed working papers.
Next comes the implementation phase. This is where the actual fieldwork happens. The auditors execute the audit for the individual subject, which culminates in a field audit report. This report is sent to the field entity, and the auditors carefully analyze the entity's response.
Finally, we enter the reporting and follow-up stage. The process begins with a draft performance audit report, which is sent to the entity in chief for their input. After the report approval process is completed, the final performance audit report is issued. But the cycle doesn't end there. The SAI then engages in a follow-up process and impact assessment to see if the recommendations were actually implemented and if they created a positive change. It's a comprehensive loop from strategic vision to ground-level implementation and finally to measuring the real-world impact.
All right, let's dive into the concept of performance audit. Now, if you look at the core objectives, performance auditing isn't just about checking the books. It's about evaluating the 3 E's: economy, efficiency, and effectiveness. We are looking at whether policies, programs, and management are actually delivering value.
Beyond just evaluation, this process is a powerful tool for accountability and transparency. It helps those in governance improve their performance and gives taxpayers and stakeholders a clear window into how government activities are actually managed and what the outcomes are. Essentially, the auditor focuses on areas where they can add the most value and provide constructive incentives for the government to take corrective action.
Now, a very important point for your exams. Who is responsible for setting the benchmarks? According to the regulations on audit and accounts issued by the C&AG, the responsibility for developing measurable objectives, performance indicators, and measurement systems rests with the government departments or the heads of the entities themselves. They are the ones who must define the outputs and outcomes in monitorable terms and standardize the unit cost of delivery.
To make this practical, let's look at the example provided, a performance audit of the enforcement mechanism for the Minimum Wages Act. This is a social welfare legislation, so the approach is very specific. First, the auditor must have deep knowledge of the industries and labor contracts involved. They need to evaluate the standard of living both before and after the act was implemented to see if it actually made a difference. The auditor will examine the returns prescribed and obtained to see if the system is working. They'll look for gaps in coordination between agencies like the Labor Department, EPF, and ESI organizations and identify any loopholes in the legal framework that might be hindering the legislation's goals.
Furthermore, the auditor can perform a critical analysis of the actual compensation required based on local living conditions. If the statutory minimum wage is significantly different from the actual cost of living, the auditor reports this to the government. In this manner, the performance audit doesn't just find errors, it examines the reasons for such discrepancies and ensures the legislation serves its intended purpose, allowing the legislature to make the necessary corrections. It isn't just about finding errors, it's about examining the reasons behind any inconsistencies or vagaries in how a program is running. By doing this, the auditor ensures that the legislation is actually serving its intended purpose. When these findings are reported back to the legislature, it creates a feedback loop that allows for real, corrective action to be taken.
To start, let's look at the broader purpose of a performance audit. It isn't just about finding errors, it's about examining the reasons behind any inconsistencies or vagaries in how a program is running. By doing this, the auditor ensures that the legislation is actually serving its intended purpose. When these findings are reported back to the legislature, it creates a feedback loop that allows for real, corrective action to be taken.
Planning for a performance audit. This is a critical phase, and the ICAI suggests a very structured approach. Think of this as a roadmap, the very first step, and the starting point for any individual performance audit is understanding the entity or the program. You cannot audit what you do not understand. Once you have a grasp of the entity, the planning process follows a logical sequence. You define your objectives and scope, determine your audit criteria, decide on the overall audit approach, and develop specific audit questions. You also need to be realistic about your resources, so you'll assess your team's skills, decide if you need outside experts, Prepare an audit design matrix, establish a timetable, and finally, intimate the audit program to the entity being audited.
Now you might be wondering, how do I actually go about understanding the entity? The text provides a great list of sources you should tap into. First, look at the entity's own documents, things like administration files, annual reports, budgets, minutes of meetings, and even their website or MIS reports. Second, dive into legislative documents, such as parliamentary debates, questions, and reports from the Public Accounts Committee or the Committee on Public Undertakings.
You should also review policy documents from bodies like the Ministry of Finance or the Planning Commission, and look into academic or special research, including evaluations done by other governments or supreme audit institutions. Don't ignore the past. Previous financial and performance audits are goldmines of information. Finally, keep an eye on media coverage and insights from special focus groups, such as the World Bank, the RBI, or even reports from NGOs.
Once you have this understanding, you move to defining the objectives and the scope of the audit. Remember, your objectives must be crisp and clear. Why? Because they dictate the nature of the audit, how it's conducted, and ultimately, the conclusions you reach. Clear objectives are the hallmark of a high-quality performance audit. While the objectives tell you what you want to achieve, the scope tells you how far you will go. It constricts the audit to significant issues and focuses on the timing, nature, and extent of your work.
Finally, we come to determining audit criteria. Think of audit criteria as the benchmarks or standards. They're the yardsticks used to see if a program is meeting expectations. These standards must be reasonable and attainable so that you can accurately assess the economy, efficiency, and effectiveness of the activities. So, where do you find these criteria? You can get them from the entity's own procedure manuals, their policies, standards, and guidelines. You can also look at criteria used by similar entities, seek independent expert opinions, rely on established scientific knowledge, or refer to general management literature and research papers.
Now, let's dive into how an auditor actually gains an understanding of the entity they are auditing. This is a critical foundational step. You have several sources at your disposal. First, look at the entity's own documents, things like policy files, annual reports, budget documents, minutes of meetings, and even their website or MIS reports. But we don't stop there. Since we are often dealing with public sector entities, we look at legislative documents. This includes parliamentary questions, debates, and reports from powerful committees like the Public Accounts Committee or the Estimates Committee. You should also examine policy documents from the Ministry of Finance or the Planning Commission.
To get a more objective view, you can lean on academic or special research, including independent evaluations or work done by other supreme audit institutions. Don't overlook past audits. Previous financial and performance audits are goldmines of information. You can also monitor media coverage and consult special focus groups, such as the Audit Advisory Committee, or reports from the World Bank and the RBI.
Once you have this understanding, you move to defining the objectives and the scope of the audit. Remember, your objectives must be crisp and clear. Why? Because they dictate the nature of the audit, how it's conducted, and ultimately, the conclusions you reach. Clear objectives are the hallmark of a high-quality performance audit. While the objectives tell you what you want to achieve, the scope tells you how far you will go. It constricts the audit to significant issues and focuses on the timing, nature, and extent of your work.
Finally, we come to determining audit criteria. Think of audit criteria as the benchmarks or standards. They are the yardsticks used to see if a program is meeting expectations. These standards must be reasonable and attainable so that you can accurately assess the economy, efficiency, and effectiveness of the activities. First, when an auditor is determining the criteria, which is essentially the benchmark used to evaluate performance, they don't just guess.
So, where do you find these criteria? You can get them from the entity's own procedure manuals, their policies, standards, and guidelines. You can also look at criteria used by similar entities, seek independent expert opinions, rely on established scientific knowledge, or refer to general management literature and research papers. These include the policies, standards, directives, and guidelines issued by the authority. They also look at the criteria used by the same entity or even other entities performing similar activities. In some complex cases, the auditor might seek independent expert opinions, leverage new or established scientific knowledge, or refer to general management literature and research papers to ensure the benchmark is robust.
First, when an auditor is determining the criteria, which is essentially the benchmark used to evaluate performance, they don't just guess. They rely on several reliable sources. These include the policies, standards, directives, and guidelines issued by the authority. They also look at the criteria used by the same entity or even other entities performing similar activities. In some complex cases, the auditor might seek independent expert opinions, leverage new or established scientific knowledge, or refer to general management literature and research papers to ensure the benchmark is robust.
Once the criteria are set, we move to deciding the audit approach. Now, this is a crucial point for your exams. Remember that there is no single, uniform audit approach that fits every performance audit. The approach you choose will dictate the methods and means you use to conduct the audit.
The text highlights several key methods you can employ. First, we have the analysis of procedures. This is where you review the systems for planning, monitoring, and checking activities by examining documents like financial reports, budgets, and procedure manuals. Then we have case studies. Think of this as a descriptive analysis, where you take a specific issue and analyze it within the context of the entire program to get a deeper understanding. Third, the use of existing data. The audit staff investigates data held by management and other sources. By testing this data for correctness and completeness, the auditor can significantly enhance the level of assurance provided.
Fourth, we have surveys. This is a fantastic way to collect information from a population to see how different events or conditions interrelate. When done on predetermined parameters, surveys add immense value to the final audit conclusions. Fifth, we look at the analysis of results. This is essentially an output-input analysis. The auditor looks at what was put in versus what was achieved to determine the actual efficiency of the program.
And finally, we have quantitative analysis. This involves examining hard data such as earnings, revenue, or the number of beneficiaries in a program. Now, a practical tip here, because the volume of this data can be massive, it's often impossible to check everything. In these instances, the auditor must use sampling techniques to draw reliable conclusions. Now, a practical point here, because the volume of data in public sector audits can be absolutely massive, it's often impossible to check every single entry. That is why the auditor must employ sampling techniques to get a representative view without getting bogged down in millions of rows of data.
Now, let's dive into the final stages of the planning process for a performance audit. We start with quantitative analysis. This is where the auditor examines hard data. Think of things like revenue figures, earnings, or specific details about beneficiaries if it's a government program. Now, a practical point here. Because the volume of data in public sector audits can be absolutely massive, it's often impossible to check every single entry. That is why the auditor must employ sampling techniques to get a representative view without getting bogged down in millions of rows of data.
Once the objectives and criteria are set, the team moves to developing audit questions. You can't just walk in and start auditing. You need a structured list of questions you want to answer. These shouldn't be simple yes or no questions, but rather a comprehensive hierarchy of questions that guide the team toward the evidence they need.
Next, we have to consider the human element, assessing audit team skills and the need for outside expertise. Performance auditing is diverse. One day you might be auditing a highway project, and the next, a healthcare initiative. The C&AG standards emphasize that the audit institution must train its staff and provide clear manuals and guidance notes. However, if the subject is too technical, the audit team needs to identify this at the planning stage and bring in an expert. But remember this crucial point for your exams. Even if the accountant general uses the work of an external expert, the accountant general retains full and ultimate responsibility for the opinion expressed in the audit report.
Finally, we come to a very important tool, the Audit Design Matrix, or the ADM. Think of the ADM as the blueprint for the entire audit. It is a structured, focused approach that ties everything together. A typical ADM will map out 5 key elements: the audit objective, the audit questions, the audit criteria, the evidence required, and the data collection and analysis method. By preparing an ADM for each objective, the team ensures that the audit remains effective and provides the highest level of assurance. It essentially transforms the theoretical plan into a practical, actionable roadmap.
Now, let's dive into the overview of auditing public sector undertakings, specifically focusing on the planning and communication phases.
First, let's talk about establishing the timetable and resources. In any audit, but especially in the public sector, planning your time and your team is absolutely critical. You can't just wing it. The selection of the audit team is perhaps the most vital part of the planning process. You need to ensure you have the right skill sets for the specific entity you are auditing. It is important that the considerations for choosing this team, along with the proposed timelines for every activity, are formally recorded.
Now, remember that the Accountant General is the one held accountable for ensuring the performance audit is completed on time. To manage this, the actual time spent is compared against the planned time, and any significant variations must be approved by the competent authority. A pro tip here: the team should always build in a buffer for things like translations, approvals, and unexpected delays. This ensures that even when hiccups happen, the final targets are still met.
Once the plan is in place, we move to the intimation of the audit program. You cannot simply show up at an entity's door. The audited entities must be informed well in advance about the intention to conduct a performance audit. This intimation should clearly outline the scope, the extent of the audit, who is on the audit team, and the tentative schedule. It's a best practice to request a formal acknowledgement of this notice and keep it on record.
One very important point to remember is that audit objectives aren't always set in stone. As you gather more information, you might find that you need to refine your objectives. That's perfectly fine, but you must record the reasons for these changes and get them approved by the competent authority. The audit program must remain flexible because it's impossible to predict every contingency at the start. Furthermore, if the audit is happening across multiple locations with different teams, the accountant general must ensure that any significant refinements in approach or new findings are shared concurrently across all teams. This system of sharing field experience should be well documented and reviewed.
put this into perspective, let's look at an illustration involving a state electricity distribution company. In this scenario, the audit objectives were designed to ascertain four key things. First, whether the total cost of providing electricity is being recovered through timely submissions to the Regulatory Commission. Second, whether tariff orders and sales instructions were issued and implemented on time and without ambiguity. Third, whether metering, billing, and collection were managed efficiently. And finally, whether the monitoring and internal controls were efficient.
Now, let's dive into a practical example to wrap up our discussion on performance audits. Imagine a scenario where an auditor finds that monitoring and internal controls were inefficient. You might be asked, what kind of audit is this? The answer is simple. This is a performance audit because it focuses on the efficiency and effectiveness of the operations. To give you a better idea of how to present this in an exam, let's look at two sample observations that would typically appear in such a report. First, consider the non-replacement of defective or burnt meters. If a large number of meters well beyond the permitted limit of 1% are defective and not replaced within the stipulated 1-month timeframe, it leads to billing on an average basis for several months. This is a classic performance failure because it results in financial losses, administrative headaches, and disputes with consumers. Second, look at the undercharging of meter rent. If the company is supposed to charge 30 rupees for single-phase and 40 rupees for three-phase meters, but fails to do so, resulting in a short charge of, say, 60 lakh rupees across 3 lakh consumers, that is a clear indicator of operational inefficiency.
Moving forward, let's discuss comprehensive audit. This is where the Comptroller and Auditor General, or CAG, assists the legislature in reviewing the performance of public undertakings. The CAG conducts an efficiency performance audit, specifically targeting areas that haven't already been covered by internal audits or professional auditors. The goal here is to pinpoint areas of weakness and extravagance to inform management.
Because every enterprise is different, the scope of a comprehensive audit varies based on the nature, objectives, and operations of the entity. What makes a comprehensive audit unique is that it combines elements of financial, compliance, and performance audits to create a holistic assessment.
Generally, the areas covered are quite broad. They include investment decisions, project formulation, organizational effectiveness, and capacity utilization. The auditors will also look at the management of equipment, plant and machinery, production performance, labor productivity, and the management of materials. Furthermore, they examine idle capacity, costs, pricing, sales and credit control, and the overall budgetary and internal control systems. Essentially, it is a 360-degree view of how the enterprise is functioning.
Now, let's dive into the overview of the audit of public sector undertakings, specifically focusing on what happens during a comprehensive audit. When we talk about a comprehensive audit of PSU, we aren't just looking at the numbers. We are looking at the overall health, efficiency, and effectiveness of the enterprise. Think of this as a deep dive health check. The auditor examines several critical areas. First, they look at the capital cost. They ask, did the project cost more than what was originally approved? If there was a substantial increase, was it justified? Or was there evidence of extravagance and unnecessary spending?
Next, we look at performance. Have the plant production or operational outputs actually been achieved? If there's a shortfall or if the installed capacity is being underutilized, the auditor needs to find out why. This ties directly into the financial side. Did the enterprise achieve the planned rate of return? The auditor also scrutinizes the how and why of the operations. They evaluate if the systems for project formulation and execution are sound. If there are inadequacies, how did that affect the gestation period and the final capital cost?
They'll check for cost control measures to see if there's wastage in raw materials, and they'll review purchase policies to ensure the company isn't piling up redundant inventory in its stores. Beyond the basics, the audit looks at innovation and maintenance. Does the enterprise have R&D programs? Are they adopting new technologies to improve profits and reduce costs? Is there an adequate system for repairs and maintenance? Essentially, the auditor is asking, are the procedures effective, economical, and well planned?
Now, you might wonder, what criteria does the auditor use to judge these things? Well, there are three main sources. First, there are the guidelines issued by the Bureau of Public Enterprises covering general, financial, materials, production, and construction management. Second, they look at industrial engineering and technical studies from experts. And third, they apply the standards of financial propriety.
To put this all into action, the starting point is the preparation of a detailed audit program. This program is built by studying the original decisions made when setting up the enterprise, its objectives, annual reports, budgets, and board deliberations. To make this comprehensive, the auditor also reviews material from earlier audit inspection reports and other relevant available papers. These audit programs serve as the roadmap, identifying the specific areas that need detailed analysis, the data required, the extent of test checks to be applied, and clear instructions for the audit teams on the ground. When we talk about these guidelines, they aren't just checklists. They are strategic maps. They identify the specific areas that need deep dive analysis, the exact criteria to be used, where to find the necessary data, and the extent of test checks to be applied. Essentially, they provide clear, actionable instructions to the audit teams to ensure nothing critical is missed.
Now, let's dive into the practical application of audit programs. When we talk about these guidelines, they aren't just checklists, they are strategic maps. They identify the specific areas that need deep dive analysis, the exact criteria to be used, where to find the necessary data, and the extent of test checks to be applied. Essentially, they provide clear, actionable instructions to the audit teams to ensure nothing critical is missed.
To put this into perspective, let's look at a practical scenario involving PS and Associates, who are the statutory auditors for a central government-owned company. In this case, the auditors are asked to report on three very specific areas. First, whether accounting transactions are processed through an IT system and the implications of any transactions happen outside that system. Second, whether there has been any restructuring, waiver, or write-off of loans due to the company's inability to pay. And third, whether government grants or subsidies were used according to their specific terms and conditions.
If you're wondering about the nature of the responsibility here, it's clear that the auditors are being asked to go beyond a standard financial audit. They are being tasked with reporting on compliance, operational integrity, and the financial impact of specific management decisions. This leads us perfectly into a very important concept in the public sector, propriety audit. Now, you might be thinking, isn't auditing just about numbers and rules? Not quite. While a standard audit looks at arithmetical accuracy, adherence to rules, and the truth and fairness of the financial statements, a propriety audit adds another layer. By definition, a propriety audit is the verification of transactions based on the tests of public interest, commonly accepted customs, and standards of conduct.
In simpler terms, while a regularity audit asks, is this transaction legal and documented? A propriety audit asks, is this transaction wise, ethical, and in the best interest of the public? It's about moving beyond the voucher and looking at the substance and appropriateness of the expenditure.
Now, let's dive into a very critical concept in the audit of public sector undertakings, the propriety audit. To understand this, we first need to understand what propriety actually means. E.L. Kohler defines it as something that meets the tests of public interest, commonly accepted customs, and professional standards of conduct. When we strip away the technical jargon, propriety audit boils down to three core tests: economy, efficiency, and faithfulness.
Now, here is the most important distinction you need to make for your exams: the difference between a regularity audit and a propriety audit. In a regularity audit, the auditor is primarily concerned with whether the rules were followed. Did we have the proper voucher? Was the sanction signed by the authorized officer? If the paperwork is correct, the regularity audit is satisfied. However, a propriety audit goes much deeper. It shifts the focus from the documents to the substance of the transaction. It asks, was this expenditure actually appropriate, and was it prudent?
Think of it this way: a transaction can be perfectly regular because all the rules were followed, but it can still be improper because it was wasteful. For example, Imagine a government department builds a massive building to house a telephone exchange, and all the tenders and approvals are perfectly documented. But then the building is never used. From a regularity standpoint, it's fine. But from a propriety standpoint, this is infructuous expenditure. It's a complete waste of public money. Or imagine a school is built but remains empty for 5 years. That is avoidable expenditure.
The gold standard for a propriety audit is the prudent person test. The auditor looks to see if the officer in charge exercised the same level of vigilance and care with public money as a person of ordinary prudence would exercise when spending their own personal money. Because propriety is based on wisdom and common sense rather than a rigid checklist, it is very difficult to frame precise, hard and fast rules for it. It relies heavily on the logic and professional judgment of the auditor.
However, to provide some structure, the Audit Code has laid down certain general principles of financial propriety to guide us. There are 4 key principles you need to remember here. First, expenditure should not be more than what the occasion actually demands. Second, the person sanctioning the expenditure must not use their power to create an order that directly or indirectly benefits themselves. Third, funds must not be used to benefit a specific person or a small group of people. And fourth, apart from the agreed upon salary or rewards, there should be no hidden avenues for management or employees to benefit indirectly.
Now, let's dive into a very important concept in the audit of public sector undertakings, propriety audit. When we talk about propriety, we aren't just talking about whether a transaction is legal or mathematically accurate. We are talking about whether it is proper or right in a broader sense. Essentially, propriety requires that expenditure conforms to certain general principles of morality and prudence.
There are 4 key principles you need to remember here. First, expenditure should not be more than what the occasion actually demands. Think of this as the prudent person rule. Every official should exercise the same level of vigilance with public money as they would with their own personal savings. Second, the person sanctioning the expenditure must not use their power to create an order that directly or indirectly benefits themselves. Third, funds must not be used to benefit a specific person or a small group of people. And fourth, apart from the agreed upon salary or rewards, there should be no hidden avenues for management or employees to benefit indirectly.
Now, it's important to distinguish roles here. The executive departments are responsible for enforcing economy in public spending. The auditor's role, however, is to act as a watchdog to bring wastefulness, improper spending, or avoidable and infructuous expenditure to the attention of the proper authorities.
To put this into practice, the auditor's functions in a propriety audit include ensuring that expenditure is properly planned, checking if the channels of spending are rightful and designed to give maximum results, and appraising whether the spending is likely to yield an optimum outcome. The auditor should also look for substitute plans that might improve operations or provide a better return on capital expenditure, and finally, examine management decisions to ensure they serve the public interest and meet the required standards of conduct.
Now, you might be wondering, what are the challenges here? This is where we encounter the issues in propriety audit. The biggest problem is that propriety is a moral term. It's based on the concept of morality accepted by society at a given time, which makes it inherently subjective. Contrast this with a standard financial audit. In a financial audit, you have clear, verifiable propositions like whether a transaction happened if the amount is accurate or if it complies with a specific law. But in a propriety audit, formulating these verifiable propositions is much more difficult because you are dealing with judgments of right and wrong rather than just legal or legal. Propriety audit is inherently subjective. Why? Because it's incredibly difficult to set a hard and fast standard for what constitutes public interest or commonly accepted customs.
Now, let's dive into a very critical and nuanced area of the audit of public sector undertakings, the propriety audit. If you look at the text, the first thing you need to understand is that propriety audit is inherently subjective. Why? Because it's incredibly difficult to set a hard and fast standard for what constitutes public interest or commonly accepted customs. Unlike a financial audit, where you have a balance sheet or a specific law to point to, propriety is more about the spirit of the expenditure.
To solve this problem of subjectivity, the Comptroller and Auditor General, or the C&AG, has developed specific norms of propriety for the expenditure of public funds. By creating these standards, the C&AG has provided a practical framework that auditors can use to verify whether government departments are spending money wisely and ethically.
Now, it's important to make a distinction here. These norms for government transactions don't automatically apply to the private sector. Private entities have different, more limited objectives based on their own management philosophy. For instance, one company might focus purely on maximizing profits, while another might prioritize social justice. However, there is still some common ground. Every organization wants efficient operations, higher productivity, and a reduction in wasteful expenditure. The text suggests a great way to reduce subjectivity if every entity, regardless of legal requirements, formulated its own norms of propriety while considering the social impact of its operations. It would make propriety audits much more effective.
To put this into perspective, think of propriety as a moral evaluation based on specific circumstances. For example, if an official travels by air, the auditor shouldn't just call it wasteful immediately. Instead, the auditor must ask, would travel by rail have been feasible and achieved the same result? This brings us to a vital point for you as a professional. The auditor must exercise discretion. When evaluating commercial decisions made in a dynamic economic or political environment, the auditor must reconstruct the circumstances as they existed at that time. You cannot judge a decision based on hindsight. If an auditor is too rigid or subjective, they might dampen the initiative of the management to take necessary commercial risks, which would make the propriety audit counterproductive.
Now, let's dive into the audit report of the Comptroller and Auditor General, or the C&AG, specifically focusing on public sector undertakings, known as PSUs. To ensure that Parliament can properly consider the findings, the C&AG doesn't just provide a single summary, instead, the reports are presented in several detailed parts. First, there is an introduction, which gives us a general review of how government companies, deemed government companies, and corporations are performing. Second, we have the results of comprehensive appraisals. These are deep dives into selected undertakings conducted by the Audit Board. Third, the report includes a resume of the company auditors' reports. Remember, these statutory auditors submit their reports under the directions of the C&AG, and this section includes comments on the accounts of those government companies. Finally, the report covers significant results from the audit of undertakings that weren't selected for a full appraisal by the Audit Board.
Now, it's important to note how this works at the state level. For certain specified states, the C&AG submits a separate commercial audit report to the legislature. For other states or union territories, the commercial details are simply a chapter within the main audit report. These state reports are quite comprehensive. They cover performance appraisals of selected companies, highlight individual instances of financial irregularities or wasteful expenditure, point out system deficiencies noticed by statutory auditors, and provide a general review of the working results.
To wrap this up, let's look at the key takeaways. PSUs are fundamentally owned or controlled by the central or state governments and are vital for India's socio-economic development. The C&AG reviews the accounts of selected government companies by performing a supplementary audit. The scope of this audit generally falls into three categories: compliance, financial, and performance audits.
A compliance audit is essentially an independent check to see if the subject matter follows the applicable criteria. A performance audit, on the other hand, is a systematic examination of evidence to provide an independent assessment of a government organization, program, or activity. The ultimate goal here is to improve public accountability and provide the necessary information for decision makers to take corrective action.